For months, you were told to just hang on, that the pain of high interest rates would end and relief was coming. The headlines promised it. The experts predicted it. The entire global economy was banking on it. That the world's most powerful central banks, the Federal Reserve, the Bank of Canada, the European Central Bank, would finally cut interest rates and ease the immense financial pressure on you, your family, and your business. But the cuts have stalled. And that quiet you're hearing from the people who control our money, that's the sound of a plan hitting a wall. This isn't an accident. This is a standoff. And you're not getting the full story. This isn't just about taming inflation anymore. This is a secret, three-front war being fought behind closed doors. A war between stubborn economic forces, intense political desperation, and the one power that central banks truly fear, the market itself. And you're caught directly in the crossfire. This is the real story of why nobody is cutting rates and what it means for your financial survival, the false hope and the painful reality. Let's be honest, the last few years have been brutal. Central banks, led by the US Federal Reserve, cranked up interest rates at a pace we hadn't seen in decades. They told us it was the necessary medicine to kill the inflation that was making everything, from your groceries to your gas, unaffordable. The medicine worked, but the side effects were agonizing. Mortgages became crippling. Business loans dried up. The dream of buying a first home felt more distant than ever for an entire generation. We were all told to just hang on because on the other side of this pain was the promise of relief, the promise of rate cuts. Throughout late 2024 and 2025, that promise seemed real. The Fed cut its key rate multiple times. The Bank of Canada was also aggressive, slashing its rate from a high of 5% all the way down to 2.25%. Everyone from Wall Street to Main Street breathed a collective sigh of relief. The worst was over. But then, in early 2026, everything stopped. In January, the US Federal Reserve met and held its rate steady in a range of 3.5 to 3.75%. A few days earlier, the Bank of Canada also announced a hold, keeping its rate at 2.25%. The European Central Bank followed suit, keeping its key rates on hold too. The message was clear and synchronized. The easing is over. The pause is here. And the question is, why? Why, when households are still struggling, when affordability is still a crisis, and when politicians are screaming for relief, would the people with their hands on the levers of the economy suddenly slam on the brakes? They give us a simple answer: inflation. Fed Chair Jerome Powell said in January that inflation remains somewhat elevated. His Canadian counterpart, Tiff Macklem, echoed this, stressing the need to keep inflation close to the 2% target. But that's the simple story, the one you read in the headlines. It's not the real story. The reality is that these central bankers are trapped. They are caught in a standoff, pinned down by three powerful and conflicting forces, the three-front war. Imagine a central banker standing in a room with three electrified walls. On one side, you have the inflation monster. On another, the wall of political pressure. And on the third, the most powerful and unpredictable wall of all, the verdict of the global market. They can't touch any of them without getting a severe shock. And right now, they are frozen in the middle. The inflation monster isn't dead, it's hiding. The first reason for the pause is that the inflation monster they tried to slay isn't truly dead. It's just wounded and hiding. While the headline inflation number has come down, central banks are terrified of what's called core inflation, which strips out volatile things like food and energy. In the US, that number is still hovering around 2.5%, stubbornly above the Fed's 2% goal. In Canada, while the main inflation number was 2.4% in December, the bank's preferred core measures were still firm, with the median core rate at 2.5%, the wall of political and public pressure. While the inflation data tells them to hold steady, central bankers are facing immense pressure from the other side. Politicians and the public are demanding relief. High interest rates are unpopular. They lose elections. In the United States, this pressure has become unusually direct, with threats to the Federal Reserve's independence. In Canada, the government is grappling with a staggering fiscal reality. The cost of servicing the national debt is spiraling. Projections from late 2025 warned that by 2029, federal interest payments on debt could hit $76.1 billion, potentially surpassing the combined amount transferred to provinces for healthcare and childcare. When you risk spending more to pay interest on old debt than on keeping your citizens healthy, you have a crisis. The market's vote, the only one that truly matters. This brings us to the third and most important wall in the standoff, the global financial market. This is the secret that isn't often discussed. Central banks like the Fed and the Bank of Canada aren't all-powerful. They can set their policy rate, but they don't have full control over the interest rates that actually affect your life, like the rate on a 5-year fixed mortgage. Those rates are set by the bond market. And the bond market is basically a giant global voting machine where trillions of dollars are cast every day on whether or not a central bank's policies are credible. Your financial survival in the standoff. So what does this three-front war mean for you? It means the era of higher for longer interest rates isn't a temporary blip. It's the new, uncomfortable reality. The relief everyone was praying for is being held hostage by this standoff. That modest drop you might have seen in your variable rate mortgage payments is likely all you're going to get for a while. For those needing to renew a fixed rate mortgage, the rates offered by banks will remain stubbornly high, tied to those bond market yields that are watching the central bank's every move. The dream of a significant drop in housing prices has also cooled. While high rates took some heat out of the market, the pause means affordability isn't going to dramatically improve. The fundamental mismatch between supply and demand remains, and the rate cuts in 2025 already started to stabilize prices. The standoff puts a floor under how much relief buyers can expect. This is a battle of attrition. Central bankers are waiting for definitive proof that inflation is dead. Politicians are waiting for an opportunity to declare victory and demand cuts. And the market is waiting to see who blinks first. The answer will determine the economic weather for the next year. So what should you watch for? Don't just listen to the press conferences. Watch the data they're obsessed with. Watch the core inflation numbers. If they remain stuck above 2%, the pause continues. Watch the unemployment rate. A sharp rise in unemployment is one of the few things that could force their hand and trigger emergency cuts. And watch the bond markets. They will signal their verdict on the central banks long before the official announcements are made. This complex standoff is the hidden force controlling your money right now. It's a global chess match where your financial security is one of the pieces on the board. Understanding these forces, inflation, political games, and market psychology is the first step to navigating them. If you want to keep getting the real story behind the headlines that control your financial life, make sure you subscribe. In this environment, the knowledge to see what's coming is the best investment you can make.